The stock market is relatively flat going into the CPI data report, and today I'm going to talk about exactly how to trade the CPI day tomorrow. So first up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so today's SPY was only up 0.03%, so we went absolutely nowhere, but intraday we did bounce off of the positively sloping 5 EMA, and we did hit some critical resistance at 411. Now before we talk about the price action and how to trade tomorrow, I want to quickly throw up a chart that shows exactly how many non-commercial traders are currently shorting the S&P 500 E-minis, and when you get this many people on the same side of the trade, not only does it almost guarantee you're not going to go much lower, but it significantly increases the probability of getting a short squeeze to send us to much higher prices. So pause if you need to look at this chart longer, but I'm going to take it off the screen, and I want you to go into tomorrow understanding that if SPY starts breaking this resistance at 411, we are going to start squeezing some of those short positions. So the first thing you need to understand is that if you are shorting this market, you are trading with the majority of traders, which typically means the market is going to go the opposite direction. Even though it does not guarantee it, there is a good probability we're going to go higher and squeeze a lot of those shorts out of their position. And I want you to understand that is only going to happen if SPY is above 411. So you are safe below 411, but instantly need to get a lot more bullish if we break out above 411. So above 411, we'll be looking for that next resistance at 414 and possibly even a push all the way up to just below 417. So on a bull breakout, those are the prices you're looking for. And now to talk about the rejection from 411, if we get a sharp rejection from resistance and we break down below support at 407, we are likely going to flush all the way down to this gap fill at 401.6. The reason I say that is because a rejection from 411 and a break below 407 is going to look like a double top, which means we're likely going straight down to that gap fill without looking back. Now at that point, we would find significant support at the rising 20 daily moving average, and then we could still start pushing higher towards the gap fills in the 420s, although it would be a little bit of a bear trap before we went any higher because this would scare out a lot of people and it would start causing a lot of people to become more bearish. So there is still the possibility this happens even with all of the short positions. Sometimes they are correct in the short term, but eventually they will have to cover those short positions. So I don't expect to see a lot of downside when there's that many short sellers in this market. So if we did get this rejection, that's only about a 2% drop from where we closed today. So it's not like there's a ton of downside before those short sellers are running into very strong support. And if you cover a short position, you become a net buyer. So I don't think this is a great time to be bearish when everybody else is trying to short the market, because I do think that is going to significantly limit the downside potential when there's that many people that still need to get out of their short positions. Remember, the S&P 500 typically goes up over time, so swinging short against a bull trend is never going to be a good idea. Last year that worked because we were in a bear market and a downtrend, but this year we have been putting in a lot of higher lows and higher highs, and we're currently in a bull trend. You can see with today's price action that 20 daily moving average is crossing back over the 50 EMA, and every single one of these moving averages is positively sloping and now supporting the buyers. Price is above all the moving averages, including a positively sloping 5 EMA, so this is still a very strong bull trend. The next thing I want to talk about is this belief that we are going up on decreasing volume, and for some reason that is bearish and there's no way we can keep going higher because we don't have the volume. That is simply not true, and anybody who has ever looked at the market and studied volume knows that there is a very good chance when you're getting low volume in a bull trend that you're going to get a low volume melt up. I can illustrate this very quickly, and all we need to do is go back to last year when we had this bull rally that lasted from July all the way into August. And you can very simply see we went from higher volume once we were putting in the bottom, and all the way to the peak of that bull rally. The entire time we were melting up on very low volume to put in the high by the middle of August. If at any point during that 2-month rally you used the volume as an excuse to not join that rally because you thought it was bearish that we were going up on lower volume, you missed the entire rally. However, if you were following price action and you saw price was putting in higher lows and higher highs, we had the bull trend and price action was above all the moving averages, you probably did very well in that month of July to August. And then once everything starts rolling over, you're going to see it in the price action. First of all, breaking down below the 5 EMA, and then eventually losing the support at the 20 daily moving average. And you will see that in the price as things are shifting and rolling over. So what I'm trying to illustrate is there is no reason for you to try to be a hero and try to call a top in this market. Wait for the price action to confirm it. Right now, this is an objective bull trend, as I just showed you, with all of the moving averages and the price above all of them. There is no way you can look at that and see a downtrend currently, so there's no reason bothering to try to call a top. However, if you can't help yourself and you're just extremely bearish and you can't help yourself but to short the market, simply manage your risk at these resistance levels and then just manage your risk if we start breaking above those levels. Make sure you're not taking on too much unnecessary risk. Simply said, if SPY started marching higher towards 420 and you're holding puts or some other short position, you're simply just gambling and taking on too much risk and you're not going to last very long anyway. That works in both directions. If you're in long positions and we start breaking the critical support levels and you're not taking off any long risk, you are also taking on too much unnecessary risk. Now, one final point on SPY is there is a very good chance we don't close the gap at 396. Because of the fact that we have too much support above that gap fill, and we will likely find buyers somewhere around 400 at the lowest. Again, that doesn't guarantee we won't break down below 400, but it's going to be a very slow process. If the market wants to roll over and die, it is not going to happen quickly. On the NASDAQ 100 triple Qs, we were down 0.64% today, and on the triple Qs, we have a lot of those big tech companies that had very strong rallies that are starting to cool down, and I still don't see a lot more downside left in the triple Qs. Price action is breaking down below the 5 EMA as we cool down, but we're coming into this support zone at the rising 20 daily moving average and the daily breakout between 311 and 312. That is a very well-defined risk level for long traders, and we have a very strong bull trend in the triple Qs. So the limited downside I see in the NASDAQ 100 would be in between 311 and this gap fill at 308. If we started going too much lower than that, then we're likely losing the bull trend. But if we went down and even closed that gap, there is still a good chance we would bounce from another higher low and still go hit the double bottom price target at 327. Now, of course, there's the possibility we just go straight there and we don't actually need to see a pullback. But even if we do get a pullback, you still have very well-defined risk and we are still in a bull trend. So as you can tell from these charts, there's just nothing telling us it's time to short the market. However, if you are shorting the triple Qs, you need to be managing your risk at this previous daily high at 321. If we start breaking above that, we're likely going to 327 or close to the August highs in the 330s. So manage your risk right here at these critical support zones and respect the fact that we're in a bull trend. So if you're swing trading, the path of least resistance is still higher until we lose this bull trend. On the Dow Jones, we were up 0.28% today as the Dow Jones is confirming the break of this bull flag look on the break of the daily higher high above 335. As you can tell, all of these moving averages are positively sloping, and the 20 simple moving average is getting very aggressively sloping to the upward direction as it's trying to come cross back above the 50. In the Dow Jones, you have very well-defined risk right here between 334 and 335. And if we break that, we're likely coming down to fill the gap at 329. However, above the breakout, we could push all the way back into the 340s, so there's still more upside in the Dow Jones as long as we're above this breakout. On the Russell 2000 IWM ETF, we were up 0.79% today, and we did gap up, and we did close above that resistance just below 177, but we still need to see a break of the previous daily high just below 179, so that will be the next critical resistance. Above that, we likely run straight to the gap fill at 181.4, which is also going to be the resistance trendline. So expect to find lots of resistance in the small caps in the low 180s. A break of that resistance would be a bull breakout and tells us we're likely breaking out of the current downtrend. So as you can tell, the small caps are relatively weakest because of the regional banking failures, but that could be changing if we start breaking out to higher highs and confirming this is a higher low on a break to another higher high. So for that reason, critical support in the small caps will be down here at 173. Because if we break down below that, then we have a lower high into a lower low, which is obviously a downtrend. On the ARKK ETF, we were up 0.62% today as ARKK is trying to break that critical resistance at 39 but continues to get rejected from that level. We have critical resistance at 39 and then 40.5 where we have the triple top, but we have no confirmed triple top until we break below the neckline at 37 and then 36. A rejection from that triple top and a break of the neckline could easily take us down to fill the gap below 32. But we're not going to say we're going there until we lose the support levels. We're not getting bullish until we break critical resistance at 40.5, and then we can get more bullish for a test of 43. On the VIX, we were up 0.79% today as the VIX is trying to find support down here right around 19, but we're still finding resistance up here at 20. For me, the VIX is very simple. It's either above or below 20, and currently it's below 20, which tells us there's low fear. If tomorrow something spooks the market, we should see the VIX closing above 20, and then we can instantly get a lot more risk off if price action loses support. On Bitcoin, we're currently up 1.67%, and Bitcoin is continuing to break out on high volume, and we did break through my price target, which means we could be running to the next target higher at 31,700. So just manage your risk right here between the breakout at 28,000 and this break of 29,400. On Google stock, we were down 1.02%, breaking down below the support just below 106, but we're still in a bull trend as long as we're trading above this support zone down here between 100 and 102. On Amazon stock, we were down 2.2% today, coming right back down to the rising 20 daily moving average and finding support right there at 100. A break of 100 would take us to critical support at 98, and we would be looking a lot more bearish if we lost that support zone. We're getting a lot more bullish if we can close above 102 and 104 for the upside target just below 109. On Microsoft stock, we were down 2.27% today, closing right on top of this support zone right around 283 and very close to closing the gap at 281. Below the gap fill at 281, we would likely find support at that rising 20 daily moving average or the gap fill at 276. And we need to break resistance at 290 to get to our gap fill target at 296. On Nvidia stock, we were down about 1.5% today, coming right back down to the support trend line right around 272, and we still have critical support at the rising 20 daily moving average at 267. Don't get bearish until we lose support, which means price needs to break 267, and if we bounce from support, we're looking for targets above at 280 and 282.5. On Tesla stock, we were up 1.24% today, trying to close back over the 50 EMA, but we do have a slight gap to fill just below at 185. If you're long on Tesla, you need to manage your risk right here at 183, or wait until we can break back above the 20 daily moving average, which is currently at 190. Above 190, we can push back to 197 and then 208. And if we get rejected from resistance, we're looking for critical support at 183 and 173. On Apple stock, we were down 0.76% today as we're coming right back down to the rising 20 daily moving average. So we're going to look for support right there at 160. If we break that support, look for the gap fill at 158.5, which is also our support trend line. I still think Apple is likely going to put in a higher low before we push up higher towards 169 to 171. On the financials, we were up 0.87% today as we are confirming the break of the previous high at 32, which means we're likely going to push towards 33. The industrials gapped up today and closed up 0.6% higher, but found resistance at the 50 EMA, and we now have gaps to fill at 98.6 and 97. On the healthcare sector, we are up 0.34% today, still finding resistance at 134, so wait for a confirmation of that resistance before you get bullish. On the energy sector, we are up 0.95%, bouncing off of the rising 5 EMA and continuing to build a bull trend, so you can stay bullish as long as we're above this gap fill at 83 to 84. So jumping back over to the S&P 500, tomorrow is likely going to be a very large move in the market, and there is still a very good chance we continue to push higher in this bull trend and squeeze out the short sellers. If we get rejected from resistance, just manage your risk at support and don't be scared to trade this market. Just manage your risk at either resistance or support and try to trade with the direction of the trend. Trading against the trend is very difficult and you're going to have a much more difficult time staying profitable if you continue to fight the trend. If you want to come trade with other price action traders and get access to all of my intraday updates and analysis, come join us over at the Stocks Channel Trading Discord community. I also have my own trade alert service called Bank Trade Alerts that sends you all of your buy and sell alerts directly via email and text message and only trades the ETFs TQQQ and SQQQ. You can find out how to join the Stocks Channel Discord or Bank Trade Alerts by clicking on the links in the description of this video. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.